Good morning, everyone. Thank you for joining us today. Give it a couple seconds as more folks are joining us this morning. All righty. This looks like a good time to start, Lou. All righty, everyone. Hello and welcome to Angel Investing. I am Eileen Villa from the Maricopa Sbdc, and I will be the facilitator for this webinar. I will be monitoring the chat throughout the webinar. So if you have any questions, make sure to put them in the Q&A so that they do not get lost. As everyone is joining us, if you could please put your information in the chat, please. And now we will have our amazing speaker and business analyst, Lou Farina, give an overview of the Sbdc.
Terrific. Thank you very much, Eileen, and good morning, everybody. Thank you for joining us this morning. And we've got an action-packed hour and a half or so of material to talk about angel investing. I'm Lou Farina from the Sbdc, and I here focusing on technology commercialization, and a lot of that has to do with early stage investing and angel investing. So this is me for those of you who I don't know. So my background is in corporate ventures, spending a lot of time with the corporate Fortune 50 and their venture arms. Also, I've been an angel investor here in town, consultant for ASU. I'm a reviewer for the National Science Foundation for their SBIRs, and more recently an Sbdc analyst, where I work with many small businesses here in the valley and in the state, many times focusing on early stage investment as a prerequisite to launching your business. So let me tell you a little bit about the Sbdc before we start. So we're part of a national network. Sbdc is a national program. There are Sbdc networks in every state. Ours is, of course, Arizona. We've got 10 different centers in Arizona, which are geographically located. I'm in the Maricopa Center, but there are centers in Flagstaff and Show Low and Prescott, Yuma, et cetera, all around the state. We provide services in many different areas. And on top of the list here is disaster loan assistance. And if I did this 2 years ago, that wasn't on our list at all. But we did over the last 2 years. We've done a lot of work on idle loans, PPP, some of the government programs, the Rescue Act. More traditionally, we do a lot of lender readiness. And if you need an SBA loan or a commercial loan, we know how to prepare a loan package, what lenders are looking for. We help prepare our clients. With that, we do financial review. We can do some resiliency assessments on your financials. We have marketing specialists. We have specialists in buying and selling businesses, manufacturing, tech commercialization. We have specialists in export and international trade, and even a separate group that focuses on government contracting for more mature businesses. 3 basic things we do are counseling. We call it counseling. It's advising. It's this one-on-one. Of course, it's no fee, prepay by your tax dollars. We work with clients at all stages of their business to try to move them along and create economic impact. Our relationships are long-term relationships. They start again at any different stage of the business and continue through the different stages of the business, even accumulating in an exit. We do training, and this is part of our training initiative. We do webinars. Before this, we did workshops, and hopefully sometime soon we'll get back to doing live in-person workshops. And then we've got resources. We've got tools available to our clients at no fee. Things like Live Plan, which is a business plan software. We've got some market research reports and some other decision support tools that assist us. So enough about the SBDC. Let's talk about today. And so if you're here, you've heard the term angel investing and you're interested. Looking for an investor is really difficult. And the pandemic had changed things a little bit, and we're going to talk about that. There's some unique things that have happened, and I think for the best, especially now that we're in more of a recovery mode. But the topics for today, we're going to talk about startup capital in general. Then we're going to talk about angels versus venture capital. A lot of people use venture capital in term when they really should be maybe using an angel or even earlier. We're going to talk about a profile. What is an angel investor? A little bit about what that person is and behaves, and a lot about their ROI expectation, their return on investment. This is going to be it's an important part of this presentation because it's often shocking to many businesses on what kind of return angels require to invest. We'll talk about the impact of the pandemic. We're going to talk about angel groups and different platforms, and then I'm going to give you some resources. So let's start today by conducting a very short poll. I think, Eileen, you can, if you can launch that, please let me know a little bit about your business and your experience with angel investing or angel capital. This will help me know a little bit more about you and kind of with the audience, and maybe I can tailor things a little bit to improve this presentation. So, Eileen, you should see a poll. There you go. Poll. Has your company attempted to raise capital? No, but we're thinking about it. We've pitched to angel investors. We've submitted an application to an angel group. We've secured commitment. Working through the deal terms, we've secured angel investment. So give this a little bit. And Eileen will display the results when we're done here for everybody to see. So, okay, here we go. So the majority are early, but we've got some folks that have pitched angel investors. I'm sorry, and we've got one out of our 14 participants who've actually secured an angel investment. So terrific. That is very helpful. Okay, let's move on. So. What is an angel investor? I use this slide, it kind of tongue in cheek, but a lot of folks think an angel investor is, somebody from heaven is going to come down and just make all things in our business right. Other people see angel investors, they're a little bit wary, see them as kind of wolf in sheep's clothing, folks maybe I can't trust, people who are trying to take advantage of me. Not necessarily true. Some folks, and this is funny, but they call it's like a unicorn. It's like we've heard of these angel investors, but we've never actually seen one. Where are they? Who are they? Well, I'll tell you, they do exist. And then the other and final idea many times is that if I find an angel investor, just money is going to come down raining on me, and my business will be started or grow or whatever, and there'll be a constant source of funding, and that's all I have to do is find myself an angel investor. Well, not necessarily true. So let's just talk about startup capital in the beginning. So, in the beginning, there's really two ways to fund your business. And there's actually a third we'll talk about a little bit about is grants. But the majority of ways for traditional business to start and to expand, it's either through debt, which is a loan, or equity, which is capital. Right? Equity comes from an investor who will look at a return. Debt comes from a lender who is looking to be compensated by an interest payment. So any of you who have ever tried to raise capital know that the first capital in is the trickiest and by far the most difficult. If you're part of this ecosystem in Arizona, in Phoenix, you'll know if you've trying to raise money, it's very stiff competition. There's money out there. but it is very stiff. Now, we all heard the story of entrepreneurs who've shown up in the Silicon Valley, went to a coffee shop, met somebody, and got their dog sitting business funded for $9 million just on a conversation or a couple of slides. Well, that necessarily is not the way it works. I can't say it hasn't happened, but that's not necessarily the way it works. If you're in the Silicon Valley and you're a serial entrepreneur and you've had a successful exit or two, and you've raised money and you've created value and you've created returns, money is a lot easier to get. Now, most of us aren't in that position. Most of us have to, it's maybe our first or second time, and it's a lot more difficult. So I'm going to start out by just talking a little bit about debt, because this is really an equity presentation, but I need to address debt. Because debt is a good way it is a very capital efficient way to acquire funding to expand a business. However, it's really challenging for bank loans for companies that don't have a financial track record. And the reason is lenders are really risk averse. And this is my little slide. I don't know if you've ever heard the term belt and suspenders, right? They are extremely risk averse. And there's a reason why. And it's a good reason why, actually. And I'm going to talk about it in a bit. But there are loans that are available for you. I talk about SBA loans. There's called a 7A, short and long-term working capital. You can refinance business debt. You can purchase furniture, fixtures, lots. That's usually, working capital. 504 is an existing building or land. These are really good programs. And we often help our clients acquire these loans. But again, if you're early stage and you're not necessarily bankable from a bank perspective, I'm going to jump right into some math here and just show you a little bit about the risk return comparison between a bank loan and maybe what an angel investor would expect. And let's talk about a bank loan. Let's say I want to borrow $100,000. Let's say the interest rate is 6%, maybe probably higher today. So time frame is 5 years. That's my term of my loan. So what am I going to do for the bank? At the end of the 5 years, the bank is going to be getting, right? And their profit, which is their interest, is 6% over the amortization of that loan. That's about almost $16,000. So they're going to get $16,000 for lending you the $100,000 for 5 years. Okay. Now let's take that same $100,000 and let's talk about an angel investor. What is an angel investor going to expect? Well, 10 times the investment, right? So that's a lot, but there's a reason why, because there's risk, lots of risk. And the time frame, let's say, is 5 years. And the principal return at the end is the $100,000, but the profit is 10x the investment, which is $1 million. So an angel investor on a $100,000 investment is going to expect a return of about $1 million, where a bank is going to expect a return of about $16,000, right? Order of magnitude, or 2 orders of magnitude more. Now, why is that? It really comes down to risk. Bank loans bankers are risk averse. They take your ability to have cash, your ability to generate cash, your existing operations. That's what they take into consideration. Angel investing is very speculative, very risky. And we're going to go into this return section in detail in a one section. If you are looking for a bank loan, there are lending decision factors in. You'll hear the 5 C's, but I'll talk about it a little bit differently. Bankers will look at what your experience level is. Do you have experience in this business? Do you have cash down payment? A lot of the SBA loans are requiring 20% down, 10, 20, 30% down. Is your product mature? Is it done? Is it ready to sell? Have you been selling it? Your personal credit? What's your personal credit score? First thing they'll ask, even though it's a business loan. Collateral. What do you have that they can attach to? Bankers will, for business loan, will reach back into your personal assets if they can. It could be a real estate, could be a building, it could be 401k, it could be anything. Can you write a good business plan? And what is the industry sector appetite, right? Bankers have portfolios just like investors do. They are heavy in certain industries. and seek other industries based on their portfolio composition, which we really don't know, but they all at some point in time have a taste for a particular industry, and that plays into their decision. So enough about banking. Banking is hard for early stage companies, but if you think you're bankable, it's a conversation to have, because you're not giving away any equity, right? It's not a dilutive vehicle. Now let's switch and talk about equity. And let's talk about the stages of development, from idea all the way to seed, early expansions. These are pretty arbitrary terms, but it's meant to go from left to right chronologically. So the first money in typically in any business is yourself, and we laugh because we say the second money in is typically yourself, right? So you got to have self-funding is really, really important. And no one's going to put money in from an equity perspective unless you have been able to put some money in on your own. Now, after you put money in yourself, you get this thing started, there are a whole bunch of opportunities. There's friends and family. There are public sources such as competitions like the AIC Challenge here in Arizona. There's maybe crowdfunding. There's accelerators who might provide some funding. And there are some grants I'm going to talk about. I'll just mention SBIRs if for anybody in the technology area, which is a good source of early stage funding. After you get there, after you've kind of been through this idea pre-seed, these particular areas, you can really talk to an angel investor. And then I'm going to talk about strategic investor and the difference, but that's kind of when you're prepared. You've had to raise money from other sources and really de-risked the investment from their perspective, created momentum from your perspective. And that's typically, after that, you can got to go to corporate ventures after you've raised from angels or venture capital, kind of one and the same. They act very, very similarly. I don't know if we'll talk a lot about in detail about those vehicles, but we'll talk a little bit about venture capital. And then after that, IPO, private equity, et cetera. So this is the typical progression. And it's important to know that if you're going to talk to an angel investor, they're going to look back and they're going to see where you've been and where your current investment has come from. They're never the first money in, never, ever. So let's talk about this in a little bit different fashion. Here's some data. So on the x-axis is the number of investors, so quantity. So it's a logarithmic chart. So it goes from 100 to 10 million. Okay, on the I'm sorry, the y-axis is the number of investors. The x-axis is like the deal size. How big a chunks of the money do they come in? And so if we look at self-funding, self-funding by far has the most number of investors, and it comes in chunks of anywhere from 1,000 to 100,000 typically. And about 5 billion a year is invested by people on their own to get started. Now, what about friends and family? Well, there's less transactions, maybe 1 million or so. And they come in a little bit higher, maybe because you can raise from multiple people. You can maybe a couple 100,000. But look, $50 billion is raised by friends and family rounds for early stage companies. Now, if we go to grants, well, grants, there's less grants, maybe 100,000 or so. Let's talk about SBIRs or so, 3 billion, and they come in a little bit bigger increments. You can go up to, even 1 million on an SBIR on a phase 2. But then here's your angels, right? Your angels come in typically in increments of 100,000 at the really low end to maybe 700 on kind of the high end. And there's $23 billion typically invested by angels on a typical year. Then you have venture capital. Okay, venture capital. There's compared to angels, there's a lot less venture capital firms and transactions. They come in at much bigger chunks. Venture capital. I know anybody's ever tried to talk to a venture capitalist who is very polite will tell you, come back when you need $5 million, or you can justify $5 million. It's just not in their. It's not in their best interest, or economically, they can't serve really investments, because to doing a $5 million investment is the same amount of work as doing a $100 million investment for a venture capital firm. But if you look at, and we'll talk about this more in detail, if you look at venture capital, they're about $27 billion a year in funding, so almost equivalent to angels. They're less transactions at higher values. Angels, more transactions at lower values. And then after that, you have other private equity sources, hundreds of millions of dollars or so. But what I want to point out is this little void here, and this is important for you as you think about your funding strategy, because with angels top out at 750 or so, and venture capital really want it to be 5 million, but maybe if they love you, they'll go down to 2 million, especially if they know you. There's a void there between the million and 2 million or $3 million. So you got to think about that when you're raising. This is a hard, if someone says I need $2 million to get my business started, where do I go? I'll say, well, you're too small for venture capital, you're too big for angels. Let's think about breaking that up a little bit. Anyway, okay, so let's talk about angels versus venture capital. All right, I'm gonna pause here, Eileen. I don't know if you're monitoring the chat. Any questions I can take from the chat at this point, or the Q&A?
Yes, we do have a couple questions. It says here, let me see. Are angel investors in Arizona willing to take stock in a company as a portion of the investment profit return?
They take stock in the company. We'll talk more about it, but they typically don't want a return from the operational profit. They want a return from an exit at a higher value.
Okay. And that looks like that's all the questions, Lou.
Okay, I'll move on. Okay, so angel investors versus venture capitalists. A lot of folks, when they start out, they say, Lou, I need venture capital. I need to get some venture capital. Well, let's talk about what that really means. Let's talk about how that compares to an angel investor. So I kind of alluded to some of this data before: deal sizes versus transaction volume, right? Check sizes, angels 100,000 to 500,000. I said 750 before. VCs 2 million to 50 million. I said about 5 to 50 before, maybe even higher into the 100 million. Two on a really, really low end. But if you look at the number of companies funded per year, typically about 75,000 companies are funded by angels. 3,750 companies. I know this is an arbitrary number we got from some data, but it's an order of magnitude less of VC transactions, a lot less VC transactions, a lot more angel transactions. And so, there are a lot of angels out there. There's a lot of opportunity for angels, easier to find and easier to engage. The nice thing about angels is they're willing to invest across a lot of industries. And a lot of the reasons they are is if you're dealing with a group, and we'll talk about group versus individuals, but if you're talking about a group, an angel group who is a general group will have a cross-section of expertise. And that's really good for everybody, for them and for you. And so they are willing, because of their diverse expertise, to invest in different sectors. And I will tell you that most angels, vast majority of angels, are going to gravitate towards technology-based businesses, because they typically return the highest number, and that's kind of their background. So you'll see here, I know it's a small slide, but you've got IT, software, of course. Software is the most scalable thing ever invented. You got life sciences, hardware, software, clean tech, etc. So lots of different industries. However, VCs have a higher degree of specialization. And, so there are less VC firms, of course, than angels, as we've talked about several times, but usually a VC will concentrate on 2 to 3 different sectors, and they have some deep expertise in these sectors. And I'm going to give you some examples. Kleiner Perkins, if you Google them, you'll see hard tech, enterprise software, healthcare. That's what we want. SL Partners, consumer, security, marketplace, SaaS. Bloomberg Capital, Consumer Internet, Alloy Ventures, Life Sciences, Information Technology, Clean Tech, and so they provide not only expertise in this area, but they also provide resources, deep resources after investment. So that's part of the reason that they're able to specialize. So structure and control with regard to angels versus venture capital. Typically, angels won't want to take more than about 20-25% of your company, right? And they may ask for a board seat, but they really act in an advisory role capacity. Most angel groups want to invest in highly qualified businesses and provide any expertise they can, but those businesses need to stand on their own. Now, if you get to venture capital and happen to take venture capital money, venture capital, they're going to want to take more. And matter of fact, they could even want to take a controlling interest in your firm. So you see anywhere 25 to 55%, and they will require operational voting power. So if you were able to take venture capital at some point in your journey, you got to know that that's going to come with a loss of not only equity, but a loss of control to a certain extent. They're going to have a very big say in your business and how it moves forward and what talent you acquire, what talent you have in place, etc. Okay, so next we're just going to talk about an angel investor and the profile of an angel investor. So some of this, let's see. Okay, we'll start with this slide, and this is the government speaking, the SEC. The SEC says I've got this term called accredited investor, and an accredited investor is somebody that I believe can take on risk and knows risk. How do I know they know risk and can handle risk? Well, we think they need to have a net worth of at least $1 million, annual income between 200,000 for individuals, 300 for married companies. And so these high net worth individuals who are accredited are typically known also as angel investors. And the reason the SEC has this test for an angel investor is they give an exemption for the investment. So you're not required to do most or any of really the disclosures that a typical stock would require. So you call this Reg D exemption for less regulated investments. So that's who the government are, angels. Okay. Oh, and there's more, right? This is new. Beyond 2020, they put an amendment in that said, wealth's not the sole means of establishing financial sophistication. Other accredited investors could be based on professional knowledge. Okay, so yeah, you've got some professional knowledge, still fairly small, but they opened up the door, and I haven't seen this really implemented to the extent that I thought it was going to be implemented, but there is some regulation that will allow others, other tests besides wealth or income. Okay, so let's talk about a high net worth individual and an asset allocation. Any of you who have stock portfolios probably have heard the term asset allocation. It's a matter of what assets you actually hold and in what combination, in what proportion. And based on your age, your risk profile, that asset allocation should change. Many wealth managers and or managers of assets that you might have will guide you. But anyway, let's talk about a high net worth individual and let's say a typical individual who might be an angel investor and what their portfolio might look like, right? So I'm going to say they have a $5 million portfolio, and there's a reason I'm going to say that, because we're going to do some math down here in a little bit. But of the $5 million portfolio, they're probably holding about 35% in foreign stocks, about 40% in domestic stocks, 20% in bonds, and well, we allocate about 5% to alternatives, right? And what are alternatives? Alternatives are the more risky investments, non-traditional potentially. And I don't have I don't have any crypto here, but crypto could actually fall into this category now. But other alternatives are REITs, which are real estate investment trusts, precious metals, commodities, folks trading, pork bellies and corn and oil. And here's your private equity, your angel stuff. So let's say you had 5% of your money, $5 million in angel investing. That would be $250,000. Okay. So, and what would $250,000 get you from an investment perspective? Well, a typical angel investment, if you're part of a group, is about $25,000. Groups aggregate their investment. That's how they get to the bigger numbers through their multiple constituents. But if you had 10 investments of $25,000, you'd get to $250,000. So so the other way of saying this is an angel investor to accept the risk of 10, $25,000 investments in early stage company of $250,000 rationally would want to have about a $5 million portfolio to make that, to balance it out. Okay, to be able to accept that amount of risk, and so in those terms, people ask me all the time, Lou, what would happen if you lost $25,000 or the $50,000 you invest? Well, that's just part of the portfolio, part of the game. We'll talk more about how this returns in another section. So, what do angels like? What's their appetite? If you're going to talk to an angel, what are they looking for? And here's kind of the red flags or items they're actually looking for. Depend. Management team, right? Really good seasoned management team. People who've been there before. People who have some startup experience. People who have some experience, domain experience. Some kind of credential, coachable, really, really coachable team, right? You don't want to be the person in the room that lets everybody know that or thinks that you know everything, right? Really important, coachability. Is it scalable? Is it scalable? I will tell you, software is being scalable gets a lot more of it can attract a lot more investment than things that aren't as scalable. What's the least scalable thing? Well, people, right? Services business, hourly type service. So scalability is important. Capital efficient. Right? Unfortunately, big iron hardware type investments really difficult for angels because it requires a lot of capital to get started. Again, software is a little more efficient, right? So capital efficiency. Are you playing in a market that's a big market? And is it growing or is it flat? Or so what's the opportunity size based upon the market that you're entering? Are you in the AI market, artificial intelligence? That's something that's growing significantly today. Do you have any early traction? Early traction being, have you engaged with potential customers? Have you sold to any customers? You don't necessarily have to be in revenue to get an angel investment, but you got to be pretty close. Yeah, and you have to have folks that you've done discovery with, which means that you've provided information on your MVP and that they are really interested and they can vouch for you that they are looking forward to you commercializing this product. Risk mitigation. Can you identify the risks, right? All startups, all early stage companies, I don't care how good you are, you all have risk. If you can identify the risk for the potential investor, you're ahead of the ball game. To say you have to try to minimize your risk or try to act in a way that risk does not exist, you'll be very surprised about if you go through a due diligence process with an angel or a group of angels, they will peel the onion back very quickly and get to where your risks are. And then it becomes to how you're going to mitigate the risk. So it's best up front to identify your risks, mitigate, and talk how you're going to mitigate the risks. Angels if you're looking for a 10x return, you're pretty comfortable with risk, and you understand risk. Financials, do you have a good financial plan? Projections, it's always a little bit of a struggle because we want good financial sound projections that create a very high value opportunity. But then on the other hand, if you provide something that's too optimistic, we don't believe it. So this is a tightrope here. You got to be realistic, but it's got to be attractive, and then an exit plan. So this is really important. How are you going to exit this business? Which means not how are you going to exit? How's the money going to come out? If I give you $100,000, how am I getting my payback? Generally, it's either an IPO or an acquisition. To the extent, IPO is not necessarily a good answer these days. Acquisition, much better answer. Who's going to acquire you? Why are they going to acquire you? Who has been acquired in this space? What multiple are they been acquired at? Anything that you can provide regarding some context around thinking about an exit plan is very, very attractive to an angel because they don't have to create it for you. Okay, so that's a little bit about what they're looking for in a particular startup. We could do a whole session on this, but I just wanted to give you some of the highlights. Okay, so now let's talk about individuals versus groups. There are angel groups out there, and I'm going to talk to you about some of the ones that are here in Arizona, but there are also individual folks that identify themselves as angels. Most investors that are individuals probably have belonged to a group at one point or belong to multiple groups and are looking for what I call deal flow, which is good investments either within their group or outside of their group. But I want to talk about the groups first, and then we'll talk about the individuals second. So groups, and I'll give you my my experiences when I left corporate ventures and decided I wanted to be able to become involved here in the local community. And I honestly didn't know much about angel investing. We dealt with private equity and some venture capital and corporate ventures, of course, but didn't know much about angels. Well, I found a group here in town. All right, what's this out? Let me join. That's typically the way a lot of folks come in, and they group together. And so these groups are comprised of different members. There's typically a fee to join. It's a maintenance fee. It covers the cost of the venues and some of the administration, but it's a low overhead operation. It's almost like a club membership, and then these groups will get together and form a process to screen different investments, and then the startups will come before the group at some point, a selected few, and then the group will typically decide whether they want to invest or not. And typically, I think I have a slide in this, it's not a digital decision. It's really who wants to invest. And if there's 100 people and 10 want to invest, then they go off and form their own little group and do their due diligence and make the investment. So it's really up to the individuals in the group. But the power is in the diversity of thought, right? I came in with a certain background, but there are other people in those groups with different backgrounds. I learned a lot from them. They were able to see risk I wasn't able to see. They were able to see opportunity I wasn't able to see. Okay, so this is really efficient too, right? So you get through to an angel group. If you can make it to an angel group, you're sitting before 100 investors, potential investors, let's say, or 80 or 20, or however this group how big the group has to be. Very efficient if you can get in front of them. However, let's talk about individuals. So there are individuals out there. Again, they may be part of the groups. They may be looking to invest on their own. And they've got the experience and comfort level to do it, and they will call themselves an angel investor and meet with you as a prospective investor for a prospective investment. Now, so if you're part of an angel group, you are vetted and you are an accredited investor. How do I know if this person's an accredited investor? How do I know? Well, they have to tell you. It's hard to know. It's hard to know who these individuals are if if you just meet them. So you got to do a lot more work with an individual. And honestly, there's a lot, if you're meeting with individuals, and there's a lot more meetings that typically take place. There's a lot of tire kickers. There's a lot of folks that'll say they're investors. So they are investors, but they will say, well, run this scenario, or what would happen if this happened? And so it takes a lot of time. All I'm saying is But honestly, if you can't get through to an angel group, you have to deal with the individuals, and it takes a lot of time, a lot of work. It's almost like another job. So, so here is a report, and I cited this at the end. It's an older report, but it gives you a sense if you're interested. And I don't know how much, if you have any data geeks out there that want to look about a lot of data. There's a study of 1,659 individual angels, and they go all through the demographics and who they are, how they behave, anything you want to know. It's it may not be 100% representative of today. It's probably several years old, but you can take a look at it, the americanangel.org. And again, you'll get a copy of this presentation, and it's also cited at the end. But let's talk about some interesting demographics about angels. And this is kind of current state trending, and I'll talk about some of the trending, in different directions. But right now, if you walked into a group of angels, they're going to be mostly male, not necessarily female, although females are trending, and I'll talk about that. Race, you're going to see a lot of white folks. Other races are represented. Again, I'll talk about it, and that is increasing. Age, you'll see this is, I don't know, this is kind of hard to see, but you'll see that the majority of them are 50 and over, right? 50 to 80. You'll see some younger folks, and there are some groups of some early founders that are a lot younger. But the majority of your typical angel profile is going to be 50 and up, maybe even 40 and up. So more women are becoming angels. There has been some, even before the events of the last couple of years, has really been initiatives into diversifying the angel groups. And I think there's a real it's challenging, but there's a real benefit, because the more diversity of thought you've got in an angel group, the better off you are. And I think angel groups recognize that. Entrepreneurs, as well as later leadership positions from larger companies. So that's typically what you'll find. The composition is either you've had entrepreneurs that have been successful, wanting to reinvest into the ecosystem, or somebody who's had leadership position at very large corporations. So those are the typical profiles. And there are more race diversity initiatives now than there has been, and that's just been increasing. So I think it's all on a positive trend, even though we may not be where we want to be at this particular point. So this is important, and it's just this is the data, and I want to show you the data, because if you are underrepresented, and you're not in one of these groups, and you walk into an angel group and you see a bunch of older white males, you need to be prepared. That's the majority of probably what you're going to see, and not to be shocked. Okay, let me stop here, Eileen, and I'm going to ask for any more questions in the Q&A.
Yes. So we have a question. How often do angel investors lose money?
And I'm going to talk about this in this next section, but if you screen 10, if you pick 10 and you screen them really well, and you thought they all could return the 10x or the 30x that you're expecting, probably odds are 5 or 6 are just going to go away, and you're not going to get any money from those. So more likely than not, you're going to lose money. But your objective is to make money on your portfolio, and you need the home run. And I'm going to talk about that in a little bit. Is there another one?
Yes, the next question that I have is, how do you find angel investors?
Well, 2 ways. One is I'm going to show you where the groups are, and you can go. There's a front door mechanism where you can apply. That's the easiest way. The more traditional, and the other way, I wouldn't say more traditional, is just networking. And if you're pitching and become visible in your community, and you let folks know that you're looking to raise money, they will find you typically, or you can find them. But they're out there. They're typically at events. They don't wear badges. You don't know. So it's a little bit like dating. That it?
Yes, that is it.
Okay. Second. Okay. So let's talk about, I just touched on this. Why are angels selective, right? This is, if you're dealing with early stage equity companies, and I put very in caps, this is a very high risk asset class. Very. Most startups lose money. This is a fact. And what I was alluding to, and I'm going to show you the math here, less than 10% of startups provide all of the upside returns in a given portfolio. All investments are screened for 10 to 30x, right? So when I pick them, I think I can get 10 to 30x out of everything I pick. It doesn't happen that way. The odds are most are going to lose money, and 10% of my picks, or maybe 1 out of 10, is going to provide really the return for my entire portfolio, make up for the losses. Okay. So if you looked at, if you took a portfolio and you looked at the 5-year return of angel investments. So here, this particular Wilbank study, and this is a little bit older, it said, 35% return nothing, and 17% return less than 1 of your. So, this is 50% you're losing money. 34% of well-screened investments will provide 1 to 5x. 5 to 10x 8%, 10 to 30x 2%, over 30x 4%. So this is where you're making your money. This is finding those home runs, the 10 to 30xers that make up for all of the losses and or marginal investments that you're going to make. So let's see. So I'm going to give you. Okay, so let's talk about this. Let's talk about the portfolio, the 1 in 10, the home run concept here. So let's do a little bit of math, very simple math, keep it simple. Let's assume 10 equal investments of $25,000 each. Remember in the early slides, I talked about a portfolio and $250,000. So a total of $250,000 for this particular angel investor, right? That fits well within his $5 million his or her $5 million portfolio. So what I'm looking for, that over 5 years, typically you're going to get 3.3x, which is a 27% internal rate of return over 5 years. So this, if we're able to pull 3.3x, 3.3 times your money over 5 years from your portfolio, that's equivalent to 20%, 77% rate of return over 5 years. And so when you think about it in context, right? So and again, data is a little bit older and especially doesn't include 2022, but the average stock market returned over 10 years from 11 to 20, 13.9%. So you're essentially maybe doubling that, a little less than doubling that. However, you're taking on a whole lot of risk to get that 27% rate of return over 5 years. And here's the math behind it, right? So company 1 through 10, equal investments of $25,000 equals $250,000. Okay, I used my pointer on this side. I'm sorry. The return, let's assume 1, 2, 3, 4, 5 go away. Okay. 2, you get your money back on 2. 1x is getting your money back. You got a couple they did pretty good on. 3x, you got, the 25, you got $75,000 back. And you hit your home run. Your number 10 was your home run. You've got 25x, $625,000 back on that one. So if you added it up, right, you have $250,000 invested. You get a return of $825,000. That's where you get your 3.3x. So this is where that math comes from, of a portfolio, of the high return, screening for a high return, and realistically what's going to happen with that portfolio, and then how that manifests itself into a return for the particular investor. So this is kind of, this is it in a nutshell. This is the concept, and this is why if you're going to deal with angel investors, they're going to demand, but from their perspective, demand and take on a risk in order to be able to secure a significant return. You don't ever screen anybody for 0x or 1x. Everybody here in this portfolio, you believe that the time could provide that 25x. It's just statistically, this is kind of the way that the chips fall. So, okay, let's just talk a little bit about 25x home run. What does that really mean? So let's say pre-money valuation. So pre-money means whenever you see pre-money, it's before the investment. So my company is worth $1.5 million. Let's, for arbitrary, we're just going to keep it simple. The company raises $500,000 for 25% of the company, right? So let's say somebody invests $500,000. How do I get 25%? Well, post money, right, is $2 million. 25%, or 500,000 of $2 million is 25%. So the idea is, before I invested, it was worth $1 million and $1.5 million. I'm putting, or me or my group are putting $500,000 in. Now it's got to be worth at least 2 million. I'm sorry, and assume that there's no further investments. So the selling price, let's say I get an exit, 5 years exit, $50 million in 5 years. So that's what the company is worth. So the firm, right, it was worth $2 million at the time. I got 50. That's 25x return. For an individual, I own 25% of that company times the $50 million. I'm getting $12.5 million back on my $500,000 investment, and that's where I get my 25x. Okay, so that's kind of a very simple way of talking about a 25x home run. If you've got a company that's worth a certain amount of money, after the investment is sold at a multiple, typically for significantly more acquired at a point in time down the road, there's cash that comes in and everybody gets whole. That's where you make your money. Okay, so pre-money valuation. Okay, now this I got to tell you, this is older data, so I apologize, but it's still probably pretty relevant. At 19 and 22 are probably going to be more similar. 20 and 21 pandemic, probably a little bit different. Pre-money valuation, like what value of a typical company that an angel investor invests in? And that becomes a touchy subject because the amount of money that is invested will dictate, your value will dictate what percentage you're giving away for investment. And so you got to come to terms on evaluation. Well, here's some data. Companies were up to about 2.5 million, or about 25%. Most companies were about between 2.5 and $4.5 million valued. There are some that 4.5 and 8, and then $8 million or greater. So the median valuation was about $4 million that year on a national level. This data I will say that it is a lot like real estate. Something up in the Silicon Valley is going to have a higher valuation than it's going to have in Kansas City, or maybe even in Birmingham, Alabama. The market we're in is kind of a mid-market. I consider we're kind of a second-tier market here in Arizona. The coasts are typically the first-tier markets, the Californias, the LA and San Francisco area, Boston, New York. And we're in a second-tier market along, with maybe Denver and Phoenix, of course, maybe Salt Lake City, maybe Austin. So, we probably see, this is probably representative of what we might see here in the Valley. So this gives you an idea just of, when you're talking to angels and you say, my company's worth, $20 million. You just understand the realistic, what other companies are selling for, right? Or what other, what their homes are selling for, essentially. Just gotta know that. Okay, so I touched on this a little bit, and I'll talk about it again. The exit strategy and exit is not, again, money for the startup founders. It's the company brings in money and the investors get money out. The exit, it gives the investors its return. In your defined exit strategy, can you define who the likely acquirers are, the recent exits, information about companies that are exited and bought, anything that you can present to an investor to talk about how they're going to get their money out, and you thought through it and you understand the market, is really, really valuable. And it's key. I mean, you can't really have a conversation with an investor without a serious conversation without talking about an exit strategy at some point. So let's talk about an angel investor versus a strategic investor. I'm talking about angel investors. And what about if you had a restaurant or I don't know, coffee shop, or maybe maybe you're selling your tire vendor. What happens with those? Who invests in those? Well, angel investors typically won't, right? Again, an angel investor is interested on cash return on their investment. They typically have a 5-year time horizon. Some you may say 3, some may go with 7. You need an exit plan. It's money in, money out, money in, create value, money out. I get my money back. I can go back and do it again. That's an angel investor. Now, a strategic investor is a little different, right? Maybe interested in return of the profits. They may be have a much longer time horizon, and typically in a strategic investor, there's some kind of collaboration or some kind of relationship with their existing business that that you can kind of tie together. And so either if they're a restaurant, maybe they're a supplier, maybe they're a big customer. There's usually some kind of relationship there that is symbiotic between the strategic investor and the particular and the particular company that is looking for the investment. Now, these happen all the time, but they're not angel investors, right? These are not defined as angel investors because, again, of their interest in their lack of specificity when it comes to cash on cash and exiting. So let's see, any more questions at this point? Okay. All right.
I don't see any questions.
All right. Let's move on here. Okay, let's talk about the impacts of the pandemic. Now, and I did these angel investor webinars before the pandemic, and then I did them during the pandemic, and things were changing a little bit. And this is a little bit rear view mirror right now because we're kind of through the worst of it. But there's some things that have changed fundamentally from the pandemic as a consequence of the pandemic that I think we have to recognize and work with. So through the pandemic, early stage investors, they were resilient. Most groups didn't view the pandemic as a threat. They were initially during the shock side. When things kind of stopped, there was some valuation started to decrease, but they've stabilized. They've probably gone back up again. And in the context of things, angels build companies again with a 5-year exit. So the ups and downs, not that important to them. So it was surprising that during the pandemic that it didn't really affect the angel ecosystem very much. And there were but the sectors definitely were affected, right? So anything that had to do with life sciences, digital health, especially security, mobility, ed tech, that got a lot more attention. Anything that had to do with hospitals or advertising, automotive, aerospace, that was not really desired at that point. So there were effect on sectors. But what we learned, one of the things, and we've learned this, and I think it's going to, I call it spatial diversity, is what we've learned that work need not be limited by physical space, right? I think we've all learned that people can do work in different areas and different times. There were quality of life benefits. Many people moved to different locales because they could. And what this did was, I think, before the pandemic, if you talk to angels, they're kind of a local phenomenon. They kind of expected your startup to be kind of like geographically located, right? I think we realized during the pandemic that we don't need that. So, and what that allows us to do is, again, increase access to talent. So now my startup can be based here in Phoenix, let's say, but my coders can be in Minneapolis. I could have my director of marketing could be out in the Bay Area, et cetera. So this whole thing, breaking things apart, this whole phenomena really impacted investors, and I think they were much more they are much more comfortable and continue to be much more comfortable with diverse teams that are diverse in space, in geography. And so again, typically angel groups are organized by geographic region and even geographic locale. And what this has done is, and what we've seen is a much more willingness for angel groups because of using technology and identifying groups out of state interface with these groups. And so the communication's less geographically constrained. So now the capital's less geographically constrained. So now you're in Arizona, you're not really limited to the Arizona angels. You can reach out, to the Mountain West and to other areas. And I can't say every angel group will be receptive, but many more are. And so new opportunities have been created. So there's a good side and there's a bad side, right? So you've got an increased engagement opportunity. Getting on a Zoom call now is like nobody even thinks about it, right? We just get on a Zoom call. And virtual pitching, it's here to stay, right? But there is a thing about Zoom fatigue, and we've all felt it with regard to our existing work, not necessarily with investors. But I will tell you, from the investors, it's easier to get them onto a Zoom. It's hard to keep their attention, right? Much shorter attention span. So I got this little thing: be brief, be bright, be gone. You can lose your audience in 30 seconds. So you've got to really make sure that if you're pitching virtually, that your pitch is second nature. You don't want to be doing it the first time virtually. And that preparation, that practice, that crisp messaging that we talk about in doing pitching is even more important when you're doing it over Zoom. So again, good, you can get an audience. It's a little easier to get an audience, much harder to keep their attention, and much easier for them to switch off their brains if they can't necessarily understand what you're pitching them, or if your pitch isn't really well practiced or well thought out. Let's see, additional thoughts. Now let's skip that. Let's talk about angel groups and platforms. So I've got two more sections to go here. Everybody hang on. Any questions? No more. Any questions, Eileen? Nope. Okay. So let's talk about angel groups and platforms. Here I've got, Arizona. We're going to talk about Arizona, and then we're going to talk about other things going on in other parts of the United States. So angel groups, how are decisions made? So I alluded to this when we talked about the individuals versus the group. Now this is important. Again, I'm going to reiterate it. And you see a lot of people here that are raising their hand, right? This is to represent who wants to invest, right? So the group consensus is not a mechanism. It's not let's take a vote and more people want to invest than not, or less people want to invest than do, and that's our decision. Well, no, there's typically it's these individuals who are in a group, and they if they want to invest, they are free to do so, and they can form their own group within the group. Typically there's no fund, right? It's not, angels don't typically have a fund that that it's not everybody puts their money into a fund and then we fund and invest accordingly. I got a couple asterisk here. I'll talk about that in a second. But the funding is, again, the sum of the aggregation of the individual commitments. So it's an individual commitment that drives an angel group. A lot of folks don't realize that. Now, I double asterisk this. There's a sidecar funds that do exist. So in these groups, this is the primary mechanism is these aggregation of individual commitments. However, there is what they call a sidecar fund. You can put some money into a sidecar fund. That sidecar fund will typically mirror the whatever the group decides to do. So it's a way for you to passively invest, but it mirrors the individual decisions that are made and the investments that are made by the group, by the particular group, and the individuals in the group. So very important. So angel groups, right? So local here, I'm going to talk to you about who they are, and then maybe a little bit closer and aren't within arm's length. You've got the Mountain West groups, and then you've got national groups that are out there too. And then and also we've got platforms now, and they've really taken off during the pandemic, and they were just starting. These are virtual platforms, and they focus on verticals, different specific industries. So not necessarily locales, but industries, and they'll span the entire United States. So the other thing to talk about is in the groups, there's a lot of syndication. There's a word called syndication that you'll hear between groups. So in Arizona, if one group sees a promising investment and they can't fill it, let's say it's a $500,000 round, and they can do two, they may reach out to other groups here in Arizona and say, hey, I've got this investment. We like it. You want to look at it? We need somebody to fuck around. They may reach out to, and I've seen, other folks here in the other groups in the Mountain West, they may reach out to another organization in Denver or New Mexico or Utah and say, hey, or even California, hey, we've got something good here. We're looking for somebody to fill out a round. It's not unusual for 2 or 3 groups to work together to fill out an existing round. So here are some of the groups here in Arizona. You'll see Arizona Tech Investors. They're here in Arizona, here in Phoenix, actually. They look at the whole state, but they're pretty specific on what they want. You can go on to these websites, and they'll give you a pretty good idea of what they're interested in, because they do have their own appetites. Desert Angels down in Tucson, they typically do a lot of medical bio because of the med school down there. Very familiar with that particular space. Very active group too, Desert Angels, and ATI is also, as our tech investors. Canyon Angels is here at Grand Canyon University. It's kind of hosted there. They're a little bit of a smaller group. They'll do a lot of follow-on. They don't typically lead investments that I know of, but they are also a very open group, and so they're probably the easiest group that I know of to get in front of. Golden Seeds is a group here. It is pitched for women by women. I think they'll take others, but that's kind of primarily what they're looking at. So it's a group of women investors looking to invest in women-owned businesses. Arizona Disruptors, they do SaaS, Arizona Founders Fund, SaaS. I think one of these is closed now. So, and there are some others that pop up from time to time, but these are kind of the mainstay groups. Mountain West, just a smattering of different groups. Park City Angels in Utah, Sierra Angels, I'm not sure where they are. Tech Coast Angels, that's probably one of the more popular ones in the LA San Diego area. You got Rocky Mountain, Rockies Venture Club, you got New Mexico Angels, etc. So they're out there. And then on the national stage, you've got New York Angels, Band of Angels, Chicago Archangels, Charlotte Angels Fund. So this is to give you an idea that there are other national groups out there that are outside of the local geography. And then there are some virtual platforms, and these are interesting. E8 is an energy group. They're out of Seattle, but I've got clients that talk to them all the time. The Chemical Angel Network, they're out of Chicago, but they look at they look for technology in the chemical space. Angel MD, really a lot of different doctors as potential investors looking at medical innovations, at life science angels, and there's a fashion angel. I've had no experience with it, but I came across this. So yeah, there's virtual platforms out there also. So topic 6, this is the last slide I've got, and I'm doing good on time here. Here's just some, and you'll get copies of these slides. Here's just some sites for the different data that you saw in this presentation. Some more interesting than others, but again, for those of you who like to read, there are trade associations. There's the Angel Capital Association, right? There's the Angel Resource Institute. So like the Angel Capital Association, they do webinars. They're fee-based and they're not cheap, but they provide information. Like a trade group. And so if you're interested, you can work with them or not work with them. You can pick their site and see what you can find. So anyway, I am at the end of my slides. We went pretty quickly. I'm willing to take more questions now. Hang on. If not, if you are an early stage company, come see us here at the SBDC. If you think you qualify for angel funding, even better, because we can help you, and I'm happy to work with you. So, anything else, Eileen, in the chat or the Q&A or?
The only question I had, maybe you can answer this, Lou, was about the restaurant revitalization grant program.
I can't answer that one. Right? It was on hold, and there's some new legislation, but I don't think it's made it through. So I'm not really sure. Contact us afterwards. We can set you up with maybe an answer or a counselor that may know a little bit more.
Looks like there are no questions.
Okay. Well, either that means I did a good job or maybe I didn't. So again, thanks everybody for being on. Eileen, thank you for working the technology for me. And I will tell you though, we've got a couple others coming up. We do some intellectual property webinars. I've got one coming up on SBIRs. Anybody who's interested in SBIRs should attend that. There's lots of good information. We got some good stuff going on in the state. And I have done a webinar, and I'll do another one, I think, this year on just all the different opportunities we saw in the beginning. The crowdfunding, the corporate ventures, things that kind of more of an overview of the different areas instead of the deeper dives. So you can look for that. Again, so thank you very much.
Thank you, everyone.